bull market's not done. We still got, and I think we got big new highs coming once this correction's over. And once we clear this sentiment got pretty bullish. If our final target naturally would have been $250 silver, this probably guarantees the shortages are going to be worse and that the odds are more likely now that it's going to get to $500. Once this is over with, the correction, we start the next leg up and we break out above 5,600, I think we're probably going to at least double from there. So I think 10,000 is almost, I'm going to say it's a piece of cake. Doesn't mean it's going to be an easy ride to get there, but I think it's going to be a piece of cake. And we might even get to 11 or 1,200. But keep in mind, these parabolic moves, they tend to crash. So we could go to $500 silver. We could crash all the way back down to $100 or even $50 silver.
February 2026 has hit the precious metals market like a whirlwind. After gold soared to a staggering record of nearly $5,600 and silver touched $122 in late January, the market underwent a historic meltdown triggered by a sudden hike in CME margin requirements and shifting Fed leadership. However, the tide is turning again. As of this week, gold has surged back toward the $5,000 floor, while silver lease rates are jumping, signaling that a massive supply-demand squeeze is tightening the noose on short sellers. In this video, we sit down with GarySavage, president of the Smart Money Tracker, who argues that this recent overnight attack by banks was a necessary sentiment reset rather than the end of the road. Savage breaks down why he believes we are in the second phase of a massive secular bull market that began in 2001, predicting that silver's path to $500 is now guaranteed by worsening physical shortages. He details how this correction mirrors past cycles and explains why the next leg up could see gold doubling to $10,000. Is this the ultimate dip buying opportunity of the decade, or is the parabolic crash just beginning? Watch to find out. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
We're in a correction. It still remains to be seen whether this is a minor daily cycle correction that may already be over. We may have printed the bottom a couple days ago, or if it continues and we got to go down and make a lower low, like an ABC correction, then this might turn out to be something that lasts a little longer, an intermediate degree correction. If that's the case, then it'll be maybe third or fourth week, and we would have at least 2, maybe 3 more weeks to go before the final bottom. But markets don't go straight down, so we'll have bounces. And so I tend to think most of the damage is already done. If we do have to make a lower low, I don't know that it's going to be a huge lower low. And then once it's over, it's just like every other correction that we've had for, 6 years. Once they run their course, then the next leg up begins and you get higher highs. That's the definition of a bull market. So bull market's not done. We still got, and I think we got big new highs coming once this correction's over. And once we clear this sentiment got pretty bullish. People were starting to make plans to buy their island, and that's usually about the time that you got to have some kind of a correction. So that's what's happening. Generally, these commodity bull markets, they unfold in 2 phases. So the first phase of the bull market was from 2001. Well, it double bottomed. So you could say either 99 or 2001. Double bottomed, gold did at 255. So let's say you pick 2001. That's where the bull market started. The first phase ended at that top in 2011. But that wasn't the end of the secular long-term bull market. That was the end of the first phase of the bull market. And then we had a cyclical bear market, fairly short. What was it, about 4 years? It ended in the fall of 2015. And at that point, we started the second phase of the long-term secular bull market. So this phase, the second phase, is getting pretty mature. Started in 2015. We're in 2026, so we're getting close to 11 years at this point. And we've started to go parabolic. Gold, when they failed to keep the suppression at 2000, you can see what happened if you pull up a long-term chart. The character of the market changed. That was because the banks were caught in a short squeeze in the gold market. Eventually that kind of bled over into the mining stocks. They had big moves. Silver was the last to break the suppression. I thought it was completely broken, but I guess they still got a little bit of firepower here because that was the second part of why this correction is happening. Some of it is just, we just got, way too bullish, ran out of buyers. We were due for some kind of correction anyway. And I think the banks took advantage of that and coordinated a huge overnight attack that dropped silver, whatever it was. I think it was almost 30%, or maybe it was 30% almost overnight. That allowed them to get out of their shorts because a lot of those contracts were going to stand for delivery, and they were going to have to buy physical silver at $120 an ounce to deliver. So I think it was, some of it was just sentiment got too bullish, and some of it was the banks needed a bailout, get out of those short positions. So I think that's probably what's happening, but it's not going to hold any more than any of the other corrections held. It's just going to make the shortages even more extreme, which just means that price is going to go even higher during this final phase. So, if our final target naturally would have been $250 silver, this probably guarantees the shortages are going to be worse, and that the odds are more likely now that it's going to get to $500.
In this final segment, GarySavage reveals his get-rich-slow blueprint, emphasizing a portfolio anchored by 80% physical holdings as essential insurance against market volatility. While he trades the remaining 20% with leverage, he warns that these positions can be very painful during corrections, requiring traders to buy significant time on options to survive the turbulence. Rather than exit at a specific dollar amount, Gary is watching key macro indicators. He won't consider selling 75% of his core position until the gold to silver ratio hits at least 25 to 1 or the Dow-to-Gold ratio drops to 3 or 4 to 1. He even hints at a potential third phase of this bull market that could eventually catapult gold toward a staggering $50,000. Are you prepared for the parabolic crash that usually follows these massive moves, or are you holding for the long-term moonshot? Watch to find out.
I think gold probably has a double from here once we break out. So I think our top was close to 5,600. I think maybe it even tagged 5,600. I think we're probably going to double during the last final parabolic bubble phase of this bull market. So once this is over with, the correction, we start the next leg up and we break out above 5,600. I think we're probably going to at least double from there. So I think 10,000 is almost, I'm going to say it's a piece of cake. Doesn't mean it's going to be an easy ride to get there, but I think it's going to be a piece of cake. And we might even get to 11 or 1,200. And now the other part of your question, I almost forgot. The other part of your question is this over when this parabolic move tops? Generally, I would say yes, although it might be that we just have a cyclical bear market. So let's say we get a parabolic top later this year or maybe early next year, and then we get a cyclical bear market, the same thing that happened from the 2011 top to that 2015 bottom. That was not a secular long-term bear market that lasted 15 or 20 years like the one from 1980 to 2000. It was just a cyclical bear market. It is very possible that might be what we would have this time, is just a cyclical bear market that lasts, the next 8-year cycle low is going to be due in 2030. So maybe it's only a 3-year cyclical bear market, and then we end up having a third phase to this long-term bull market. I am open to the possibility of that, but keep in mind these parabolic moves, they tend to crash. So we could go to $500 silver. We could crash all the way back down to $100 or even $50 silver. And then potentially we could start a third phase of the bull market that could take gold to 30, 40, 50,000 during that third phase. So it's possible. I'm open to the possibility. I'm not going to sell any of my physical until I see that gold to silver ratio, at least at this point, probably at least 25 to 1. So at that point, I would probably sell 75% of my my physical gold and silver holdings, hang on to the last 25%, see how much further, maybe it can get down to 15 to 1. I would sell all leverage even if we get below 30 to 1, I would probably sell at least 50% of my leveraged trades probably 75% of my leverage trades, and maybe just go completely unleveraged in my trading account. Now, the physical is a much bigger position for us. My recommendation, and pretty strict recommendation, is 80% physical. Physical that's your insurance. We can trade that other 20% in leverage. We always err on the side of caution. So like if we're trading options, we're always going to buy a ton of time just in case we get caught. Like if this were to turn out to be an intermediate correction that's going to take several more weeks, we need a lot of time on those options. That's exactly what we did. We bought a ton of time just in case we get caught. So that's our protection for our leverage, but also our leverage positions are just much smaller than our physical position. And I expect over the long haul, we're probably going to make a lot more money in our physical position, our quote unquote get rich slow position. The leverage is our get rich fast position, but sometimes the leverage is our very painful position if you get caught and have to hang on for a few weeks while we work through a correction. So those positions are much smaller than our physical position. And we may also get a Dow-Gold ratio that's maybe down to 3 or 4 to 1. That would be something else I would look at. So there's no real specific price that I'm absolutely going to take profits at that point. If silver's at $250, but the silver gold ratio is only at 40, well, I'm going to keep holding. If the Dow gold ratio is 15 to 1, I'm going to keep holding. So yeah, I'm not going to pick a set price where I'm going to buy. I'm going to be watching. Probably those two ratios would be.
As this correction clears out the island buying euphoria, the stage is set for a massive transition from a get-rich-fast mentality to a disciplined wealth preservation strategy. Gary stresses that while the ride toward $1,200 gold or $500 silver won't be easy, the real winners will be those who treat physical metal as their ultimate financial shield. Don't let the bank's overnight maneuvers shake you out of a generational bull run. Are you positioned to ride the third phase, or will you be caught empty-handed when the final parabolic move begins? Share your thoughts in the comment section below. If you found this breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.